Hey traders, Matt here from Seneca Analytics. I just wanted to jump on and chat to you about a presentation that we've done for clients a couple of weeks back, which we're starting to see play out and we think has major implications for the broader market. And we feel it is our duty to share this with the public because of what the road ahead would mean for most people that are caught unaware. So we've called this a timely warning for friends and investors, and it's really just about gold, the dollar, and Bitcoin, and the road ahead that lies for them. So the trade which we think the market is discounting, and there's clear signs that what we're starting to see, especially what we saw in the markets yesterday, is the reflationary trade, which comes from the expansion in the level of output of an economy by government stimulus using either fiscal or monetary policy. So we've seen a lot of stimulus coming from 2008, but we never saw the reflation, the inflation that markets were looking for. And we believe the markets have let that narrative slip to the wayside when in reality it is still very much alive. So all of this started when we were looking at the dollar chart, and what we feel we're looking at the road ahead for the dollar is a strong weakening, kind of below 93 to around the 85 level on the DXY before a big move up to the upside. And we've started to see this move already, reaching peaks of 103 on the DXY, and we've seen a turn and a consolidation, and which we believe just came to an end, and we're going to start to see a weakening in the dollar over the next few weeks and months ahead. We also saw a strong turn in the gold-silver ratio, and we believe silver is going to outperform gold in the months ahead as well. And this has major implications, as you'll see moving forward. And what this presentation is really about this gold-silver ratio. So the gold-silver ratio for the last 150 years at least has been a good indicator of the condition of global monetary markets around the world. So during periods of inflationary monetary proliferation, we see the ratio fall. We see silver outperform gold and the gold-silver ratio come down. And during areas of deflationary monetary destruction, we see ratios rise. So typically during periods of war, we see an increase in inflation and we see the gold-silver ratio decline. And during periods of monetary destruction, like we saw after the European debt crisis, we saw gold start to take off. And as gold takes off, liquidity crisis kicks in, we see the ratio rise. So gold-silver ratio is a proxy for monetary inflation. So in 2008, with QE being unleashed, we saw the ratio reflecting wild inflation expectations. As you know, almost everyone believed that QE was a modern equivalent of the Weimar printing press or a systemic debasement by the national mint in the US. And it was not until the second monetary shock struck in 2011, i.e. the European sovereign debt crisis, that this illusion began to fall. So the gold-silver ratio peaked in QE1, and we saw a strong pullback. When then we saw a bottoming out in April 2011 as the European sovereign debt crisis took hold, and the broad global illiquidity crisis began in earnest. The ratio has steadily risen since, because capital supply remains broadly strained and at times simply unavailable. So as we saw in 2008, QE1 commences, and we saw a 64% decline in the gold-silver ratio as inflation expectations took hold. We then saw the European debt crisis, and we saw a complete turnaround, and gold again start to outperform silver. And you see this in the silver chart, silver US dollar. QE1 begins October 2008, and we saw an over 400% increase in silver over that period. And then we saw the European debt crisis, and as that ratio turns around, we saw a strong decrease in the silver price as deflationary conditions took over. We saw the same thing in Brent crude, QE1. Just before QE1, there was a massive decline in the oil price as oil price plunged. And a couple of months after QE1, we saw a turn in the oil markets, and the oil markets then rallied 250% to go back up to the $120 level. We saw the same thing in the broader CRB index. the commodity index. We saw a bit of a lag after QE1, but then we saw a strong rise in broader commodity prices. And a lot of people will say, but there was no inflation in 2008. And what happened in 2008 is that the banks had their own liquidity issues. So all the QE funding that came in basically went onto the bank's balance sheets and never made it into the broader market. So in 2008, only a small share of the Fed's massive injection of high-powered money was relent into the banking system. And M2 never grew by more than 10% a year, even after subsequent rounds of large-scale asset purchases by the Fed. And coming to 2020, what we've seen is the same thing. Central banks have stepped in and turned on the quote-unquote printing press. And we've seen central banks on the hook to help fund this debt increase. Since the end of February, the Fed's balance sheet has already grown by 60% and is on track to more than double by the end of the year. And we've even seen novice banks like the Bank of Canada and the Reserve Bank of Australia start their QE programs and increasing their balance sheets by 43%. And what's different this time around is that we've seen M2 spike through the roof. And the only few times in history when M2 growth exceeded real output growth over a 5-year span by the same or faster pace than is currently the case was the inflationary periods of the 1970s to 1980s and the late 1940s. So whenever you see M2 outperform real GDP growth, we see periods of inflation to follow. And what we're starting to see on news headlines is that US grocery stores costs are jumping the most in 46 years. So we're starting to see these inflationary pressures in the consumer market. And I also feel with coronavirus, what we're going to see is pressure on supply chains. And that pressure on supply chains is going to boost prices, which in turn is going to add to inflation expectations. What we've seen is the gold-silver ratio already plunging 21% from its peak in early March. We're seeing silver climbing 51% since early March. We're seeing Brent crude climbing 121% since the end of March. And we're starting to see the broader commodity index start to climb, having already risen 30% since kind of mid to end of March. Another thing we see in 2008 is EM currencies start to strengthen as the dollar starts to weaken on inflation concerns. And in 2008, we saw a 0.618 retracement of kind of global financial crisis levels. Once QE taps were turned on, we saw a 61.8% retracement of the Mexican peso. And the chart for EM are showing that same decline for us. We see the same thing in the South African rand, which also had a really strong performance after QE1. And the charts are suggesting a similar thing with moves down to at least 15.50, with the possibility heading as low as 13. And we saw the same thing in the Turkish lira, which also had a 0.618% retracement following QE1. And the charts suggesting the same thing this time around. And what we've just seen over the last few days is a break of a very important trend line on the Turkish lira. We've seen a turn in the US dollar ZAR, we've seen a turn in the US dollar Mexican, and we're seeing consolidation at the top, which suggests a topping pattern for more downside. So what does that mean for gold, the dollar, and Bitcoin moving forward? So as we've said, what we're expecting in the dollar is kind of short-term weakening moving forward as inflation expectations take hold, with levels of 93.26 and 85.4 being key levels for us, kind of a minimum move down to 93.26 and potentially as low as 85.4 on the DXY. But once we reach these levels, it's going to complete this correction, this ABC correction, and then we're going to see the US dollar being really strong. And that kind of strength will be the dollar's downfall, because the strength is going to bring the global economy to its knees and is going to result in a kind of rebalancing of global debt and a resetting of the global financial system, and what Ray Dalio terms the long-term debt cycle coming to an end, and we'll have to have a reset of the long-term debt cycle. What this means for gold is that in the short term, we're going to see this rally, which we've already seen over the last few weeks and months. This rally should continue to around the 2000 level, but we don't believe this is the rally which leads to a 3x, 4x, 5x in gold, which a lot of gold speculators are talking about due to debasement of the dollar. We see this as a short-term rally up to around the 2000 level, 2200, somewhere around there. And following that, we're going to see a strong pullback as the dollar super spike occurs. We're going to see a pullback to, depending where we top out, to around the 1.4 to 1000 level dollar per ounce. And then, only then, are we going to see a turnaround and the next real move up in gold towards 3000 and potentially higher, given the financial conditions that are going to cause this move up. And Bitcoin, we're going to see the same thing. We're going to see Bitcoin rally to at least 14,000, potentially as high as record highs. And once the dollar super spike occurs, we're going to see one more strong move to the downside in Bitcoin. So this isn't the big move that everyone's looking for, where Bitcoin goes to $1 million per Bitcoin. I think we're going to see one last move to the downside as the dollar spike, the dollar super spike takes hold and global financial conditions get pushed under pressure once again. And then once we see that reset in the system, that reset in the global financial system, only then are we going to see Bitcoin rally to those kind of levels. So we do see short-term rally in the Bitcoin and in gold, but we think those are going to be short-lived as the dollar, as inflationary pressures cause the dollar to spike, pressure on the Fed, more importantly, to raise interest rates, or potentially a liquidity crisis in Europe and around the world, especially in Asia. Then we're going to see the dollar rally, which is going to cause Bitcoin and gold to fall in price. And these are the ones you want to buy. When you see this final dip in Bitcoin and gold, that's when you want to get into those monetary inflation hedges. And only then are we going to see a move into the new global economic situation or new global economic system. We believe we're moving into a reflationary trade. We believe that gold and Bitcoin are going to benefit in the short term, but when inflation really starts to take hold, the Fed's going to be put under pressure to raise interest rates, and that raise in interest rates is going to really put pressure on the global economy, as global US dollar debt around the world leads to basically a short squeeze in the dollar, and the dollar goes through the roof, causing everything to fall in comparison to the dollar. EM currencies are going to be hit really badly. Gold's going to even get hit, Bitcoin's going to get hit, and only then, once that move is complete, will we see a massive rally in Bitcoin and gold as a kind of the new monetary system takes hold. So we feel it's important that investors be aware of this and to prepare themselves for a very volatile future ahead. So if you'd like more information, you can contact us at cynicalytics.com or get hold of us on Twitter. Follow us on Twitter at cynicalytics. That's where most of our stuff goes out to the general public. So stay safe out there, guys. Chat soon.